The Gap has lost almost 2/3 of its value over the last couple of years. But my question is, has all of the pain already been priced into the security, and can it really outperform at this point? Let's take a look into this story. And so guys, as you smash that like button, let me run that intro. Now, I've been covering a lot of retail on this channel, and I have done so throughout the history of this channel, but the one thing that I really haven't covered is a potential turnaround story in the retail space. Largely what I've been doing is assessing whether or not a retailer has the ability to keep their strong results going forward, despite the market not believing that they can. And so in this situation, it's a little bit different. Can the Gap turn its operations around? And you guys may recall that over the last couple of years, Gap has really mismanaged their business, and the shares, just over a 5-year time horizon are down 2/3. And so anytime a business loses 2/3 of its value, or approximately 2/3 of its value, the question I have is, has the pain been priced in, and what are they doing in this particular situation? Is this just the market over or underreacting? Was the company overvalued here and now it's more appropriately valued? Let's take a look and see exactly what's going on. Now, first, if you guys aren't familiar with the company, or you just need a reminder, recall, they have one major brand. This is the powerhouse for the Gap, which is Old Navy, and then they also have the Gap stores. They have Banana Republic, and of course they have Athleta. And so the first question I had when I was analyzing this company is, what happened? What caused the share price to decline so drastically over the last couple of years, as you can see from the chart here? And here's what I managed to find. So in the fiscal year 2022 annual report, basically the supply chain issues caused them to receive inventory late, and thus they had to write it down and engage in higher levels of promotional activity, or at least that's what this 500-foot view would be. But notice what they said here. The company had difficulty managing the timing of seasonal inventory inflows amidst global supply chain disruptions. The company recorded pre-tax inventory impairment costs of $58 million, primarily related to delayed seasonal product. Okay, that's fine. But check this out. And extended size of product at Old Navy. And so what happened here, this does not seem like a supply chain issue. And what really happened is they tried to be too inclusive. They tried to have too many sizes. And so what ended up happening is they had too small sizes and too many too large sizes, and not enough sizes for the average body. And so of course, if you have merchandise that nobody's buying, you're going to take huge impairments. And at the time, the Wall Street Journal actually did an article on this, and they summarized it much better than I did. They said, Old Navy set out to make clothes shopping more inclusive for women of all body types. It ended up with too many extra small and extra large items and too few of the rest. A mismatch that frustrated customers and contributed to falling sales and a management shakeup. Yes, there were firings that happened, or at least people stepping down in leadership positions as a result of this issue. And so the first person to go is always the leader of the group. And so, Old Navy's president and CEO Nancy Green stepped down as the Gap decided to find another leader for that particular role. In her absence, the overall company Gap CEO Sonia Singhal took over, at least temporarily. And recall that at the time, she herself had led Old Navy before she stepped up to lead the overall company. However, the news got worse for Sonia, because a few months later, she also stepped down. And so the Gap was just cleaning house. They got rid of their CEO, and they got rid of the CEO for the Old Navy business. So the question is, who took on leadership for Old Navy? And that was a gentleman by Mauricio Barbido. I can't really pronounce his name, but you know what's interesting? I actually saw a CNBC video of this guy maybe 15 years ago, talking about how he was working internationally for Walmart. This is one of the most internationally experienced retail people I would say that I've ever seen. And so just check out his background. He has been with Walmart since 1995 and has worked in Argentina, the US, Puerto Rico, and Chile. Also, recently, he was the CEO of Walmart Canada, my home and native land. And so, if you want to fix Old Navy and create a strategy for international expansion, this is your guy. And why would you want to hire a guy who has a ton of experience with international expansion? You would want a guy like that because if you look at their sales in the last quarter, or the Q4 of 2022, this I pulled from their 2022 annual report, you can see the substantial majority of Old Navy sales come from the US. A smaller amount comes from Canada, and then virtually nothing from anywhere else. So you have a lot of white space, especially notice Gap Global. They're starting to build in Asia. Why can't you get Old Navy there as well? So there's a lot of opportunity here, and it would work really well for the company to, one, turn around its business, but two, get someone in there who can expand the brand internationally. And so why not get both of those opportunities in the same person? And so that's who this is. And so I'm actually very excited and optimistic for this leadership change because I really feel as though, one, this person will be able to run a tight ship. I mean, he worked at Walmart for a long time, the best performing retailer in the world, or one of them at least, on the lower price point level. And so you got a lot of this experience coming in. And two, you got a guy with a ton of international experience as well. And so of course I want to partner with this guy, or at least I'd be excited to. But the truth is, he's more of an operator and an international expansion executor. He's not really a turnaround artist. And I think, largely it's because Walmart has never really needed to turn around. But if you wanted to replace your CEO with someone who's been able to turn a company around, the overall CEO choice for the Gap couldn't have been better, and this is who I'm talking about. The Gap named Mattel's former chief operating officer, Richard Dickson, as their new CEO. And so recall, guys, Dickson, who's 55 years old, was a co-president at the Barbie toy maker Mattel and will leave on August 3rd. Of course, he's already left and he's joined the Gap. He's been lauded for sparking the turnaround that boosted Mattel's vulnerable fashion doll back into relevance. So now you got two really important pieces to the puzzle here. You have somebody who's very good at turning around a business, and I don't really think the Gap needs that much experience with turning around a particular business because they've already started to turn the business around, and I'll show you what the results look like. But the fact that you have this guy who has a ton of experience, who's joining right at the top, I'm very excited and optimistic for that. But I'm more excited and optimistic for the leader that they got for the Old Navy brand. So the fact that you got these two heavy hitters, these are 400 average batters that you're bringing to the plate into the same company, and you guys can see how interested I am at this potential turnaround story. Obviously, I would never go all in on anything. Always talk to your investment advisor before you make a decision. But here's what I want to show you about the results already turning around before their new CEO even took the helm. And so here are their Q2 year-to-date results. And yes, of course, revenues are a little bit lower year over year than they were last year. However, notice how improved the margins are. And so they're more profitable now year over year, because margins are up and operating costs are slowly coming down. And that was the real issue with the company. It wasn't the top line hurting. It was the fact that they were selling the product at low gross profit margins, and they had ballooning operating costs as well. And so they're bringing both down. And so already year to date, Q2 year to date of 2023, the company is already doing well without the heavy hitter CEO coming in to lead the organization. And just taking a quick look at the balance sheet, you can see that the supply chain related inventory build is being worked out. So you can see that the inventory has already declined significantly, which is good. I mean, part of this is just the write down, of course, but the other part of it is that they've really been able to turn this thing around and bring the company back to what it used to be. And so thus far I told you the story, and the story is very important. But what does this mean to us as investors? What does this turnaround potentially mean in terms of equity yield or potential earnings that we can generate? And so let's go into the model quickly. From 2013 to around 2019, this was around a $2 or $3 per share security on average. Call it a $2 stock on average. And then of course, post COVID or during COVID and beyond, you can see that it turned into a negative earnings company. And so the question is, if they can orchestrate a turnaround, what could the potential opportunity be? Well, my thoughts are, if you could potentially turn this back into a $2 per share security in the next couple of years, I call it the next 4 years, this could easily become a $30 to $40 per share stock, whether you're using a 15 or 20 times multiple on that. Obviously, you may not necessarily use that high of a multiple. I'm definitely not using that high of a multiple to forecast. I think I'm using 12.5, but even at 12.5, you're looking at a $25 per share company divided by, of course, the current share price. You're looking at more than a one bagger, maybe 1.25, 125% return. So there's opportunity here is what I'm trying to say. And so the question is, what do I think this thing is valued at? And before I get into the valuation, I just want to make a quick plug. You can actually get access to all of my models at that lower tier of the Patreon. And if you want to join us for an extremely informative live presentation, you can join us at that higher tier. And just an FYI for everybody who subscribes, there is a 100% money back guaranteed, because I'm in the business of creating relationships and partnerships, not sales. And so if you feel as though you're not getting a value, just let me know and I'll refund your first month's subscription. And so just diving into the valuation, you can see that I'm using a terminal multiple of 12.5 times earnings. And so I penalize them for the debt that they have on their balance sheet, but they don't have a material amount. They have a lot of excess cash, or cash in general. And so that offsets it. And so, the company trading right now at $10 at $11 per share. This was as of Thursday of this past week. It's trading, I think, at approximately 30 or 35 to 40% of its intrinsic value. And I really believe that the company's worth around $30 per share. But interestingly enough, I think it's trading at 13.7 times earnings right now, which gives you a 7.3% equity yield. And so it's interesting. It's not expensive. And I think that there's a lot of room to run if there's a potential turnaround. Now, I know that a lot of people like tuning into this channel to look at the options opportunities as well. And so I built it out for you. But I don't know if this particular opportunity, because of the valuation or the current price relative to the valuation, I don't know if I would want to enter into the options position, but it is lucrative. And this is what I mean. The at the money or just under the money covered call, so the strike price is $10 per share, yields you a premium of around $3 per share. And then, of course, you're also getting dividends on top of that. And so, what does the valuation, or what does the potential return in both of the scenarios yield? So remember, if you write a covered call, if you sell a covered call after buying the securities, what's happening is you have a potential return if you're assigned on the covered call, and you have a potential, which means that your securities are taken away from you, and you're just left with the price at which they're taken away from you plus the premium. Minus, of course, what you paid for the security. So what's the yield there? And then, of course, the other potential is that you're not assigned on the covered call and you're left with the shares that you own. So the price of the shares that you own less the premium that you received for the covered call. So, I like to look at both of the binary scenario, and you can see that if you're assigned on the call, you have a total annualized yield of approximately 26%. And if you're not assigned on the call and the company returns to an EPS run rate of $2 per share, you have an annualized equity yield of 28%. So although, I put it here, although the covered call does look good, and it is the January 17, 2025 covered call, so you're just looking at a little bit more than a year, and you can see that here with the number of days, so approximately 500 days until the strike. Although the covered call does look good, I don't think options are the move in this particular situation, and that's just my opinion, of course. I think just flat out owning the shares is likely going to be my strategy, if I could only spell strategy properly. This may turn into a longer term buy and hold play from my perspective, because recall, guys, that if the shares are currently trading at around $11 per share and this turns into a $2 per share company, that in itself is an 18% equity yielding position. And so there's a lot of money to be made, and I think there's a lot of money to be left on the table if you potentially move into the covered call opportunity. And so that's why I'm thinking that this, at least in my opinion, might just be your traditional buy and hold. But I want to know what you guys think. Let me know in the comments below. Now, recently there were a few updates with Alibaba. Their CEO stepped down, and I actually broke that down in detail in this video right here.